This is Bajaj Allianz Life Goal Talks.
Hello and welcome to a very special episode of Life Goal Talks podcast brought to you by Bajaj Allianz Life. My name is Rakesh Sharma. As India makes its way towards becoming a $5 trillion economy in the next 4 years, the union budget indicates how the country's money is managed by the government. It determines how industries and businesses grow and what direction our economy takes. For individuals like you and I, it determines how we can manage our own money, what we have to pay in taxes, what we can save, and so on and so forth. So on this episode, we are joined by Mr. Sampath Reddy, the Chief Investment Officer, CIO of Bajaj Allianz Life. Mr. Sampath Reddy manages an AUM of over 85,000 crore rupees along with a team of fund management and investment experts. It's his leadership and prudent investment expertise that has enabled to strengthen the customer's trust in the brand as the team continuously delivers towards the brand's promise of getting their life goals done. So a very warm welcome, Mr. Sampath Reddy. Welcome to Life Goal Talks. My first question to you would be this. As someone who has tracked the budget for so many years, how do you view this union budget from a broader perspective?
I think overall the budget and transparency in the last several years has gone up tremendously in terms of budget numbers, especially. And if you see the revenue growth as such is expected to grow around 12%, which is pretty much in line with the nominal GDP growth rate of 10.5%. And so that's point number one. So the credibility of the numbers is really, really high. While the nominal GDP is growing around 10.5, if you see most of the internal numbers, especially the indirect taxes as well as direct taxes, the growth rate assumed for the FY24 is also around 10.5-11%, which means the numbers are very, very realistic in terms of revenue growth targets. In fact, FY23, the budget numbers are exceeded quite well. I'm sure FY24 numbers are in that backdrop will be easily achieved, if not exceeding these numbers. And expenditure side, this budget is clearly targeting growth push, especially if you see most of the money, or rather most of the growth in the expenditure side is actually happening on the capital spending. Capital spending last year was around 7.5 trillion rupees, and this year the government is allocating about 10 trillion rupees towards capital spending, capital expenditure side, which is a growth of 33%. And this in the context of overall expenditure growth of 8%, the government is putting a lot of emphasis on growing the capital expenditure side of it. That's a really commendable thing. That's why I think this budget is a growth-oriented budget, especially, given that we have come out of the COVID period and world over there's been a significant inflationary pressures, including that of India, because of which interest rates have moved up. And there has been a fears regarding the potential recession in most of the developed world, and it could have an impact on some of the countries like us in terms of overall growth slowdown. In that context, the emphasis towards capital expenditure side is really commendable.
The capex being budgeted to rise by 33% to 10 lakh crore rupees in FY24 is obviously great news, and that is obviously indicative of the infrastructure thrust in the budget. Could you elaborate a little bit more on the capex itself, as well as the other schemes that the government is taking on in this direction, Mr. Reddy?
Government has already been taking steps to push the overall investment activity in the country. As we all know that there's been a PLI scheme, which is productivity linked incentive scheme. Under this scheme, government has extended incentive to the several sectors, up to almost like a 2 trillion rupees worth of incentives is being extended towards new manufacturing facilities and capacities. Because of this, the PLI scheme is really targeting towards capital expenditure of the private sector. This budget is, doing its bit on the government side as well. As I mentioned in the budget, they provided a significantly higher amount towards capital expenditure, which is about 33% kind of a growth, to complement what the private sector is likely to under the PLI scheme in terms of capital expenditure investments. The government is also planning to spend substantial amount of money in creating the infrastructure. So both government's budgetary support towards capex and as well as PLI scheme together, I think will really propel the fixed capital investment formation in the country in a meaningful way. That's why I would think this is a lot more a growth-oriented budget. And in fact, if you see, to get the numbers in the context, pre-pandemic levels, capital expenditure as a percent of GDP used to be about 1.5%. Now today, that has gone up to almost like a 3.5%, 3.3%. So, the emphasis towards creation of the asset or creation of the infrastructure is clearly evident. That's why I think this particular aspect is something we like in this budget.
You also mentioned fiscal consolidation earlier. Could you please elaborate a little bit more on the same and how it stands to benefit the Indian economy in the coming fiscal year?
Especially given that the interest rates have moved up on the back of inflation, government's borrowing program will put more and more pressure on the bond market. And with the prudent fiscal policy, with the prudent fiscal deficit approach, we will be able to reduce the overall interest rates in the economy. That's point number one. And of course, prior to the pandemic, our fiscal deficit was, at a very comfortable level of 3.5 to 3.4%. But because of the COVID, the expenditure had gone up and revenues had got shrunk, because of which we had seen in a sharp spike in the fiscal deficit. And last year it was 6.4%. And this year, FY24, the government has proposed to bring it down by 50 basis points to 5.9%. I think that was very much in line with the market expectations. But more than the this year's number, government has also indicated its glide path towards reaching a fiscal deficit of 4.5% by FY26. I think that's really doable. Given that there's been a good tax buoyancy, given that there's been a lot of investments that are taking place towards the capex capital creation and then subsequent impact of it and the growth. Because of these reasons, I think to reach a 4.5% of fiscal deficit by the FY26 is doable.
That is very good news indeed. A 4.5% fiscal deficit is something the country could rejoice in. But what our listeners would most rejoice in would be to understand the most important thing that they look forward to at the end of a budget session. What have been the key announcements related to taxation?
Till about 2 years back, there was only one tax regime, which is, there's only one option, like everybody to certain amount is tax free, and above that is, different slabs were there. So in the 2 years back, what they've introduced, they're called a new tax regime, and they've said tax rates and tax slabs are slightly different for this new things, but you will not have certain exemptions and all that. But not many people moved there because incentives on the exemption side is good enough so that you don't need to shift to the new tax regime. The new tax regime is actually aimed at simplifying the overall personal income taxation. To make that new tax regime more and more attractive, the government has liberalized some of the limits. Earlier, the tax rebate was up to 5 lakh. The same thing has been raised to 7 lakh rupees, which means, income up to 7 lakh annual income, the individuals need not pay, any income tax. So that's a point number one. And secondly, the earlier in the new tax regime, the standard deductions of 50,000 rupees was disallowed. Under this budget, standard deductions of 50,000 rupees has been introduced. So that is another positive. So overall, based on these two things, the new tax regime has been made a lot more attractive. Not only these two, and the third point is that overall, in terms of the number of tax slabs also been reduced under the new tax regime. So overall, the new tax regime, which was introduced 2 years back, has been made much more attractive so that a lot of the individuals will move towards the new tax regime. That's point number one. And also they made the new tax regime so like a default tax option. So which means someone who is like lazy or not able to choose and not really choosing, for them automatically they will be under the new tax regime. That's also quite useful. The surcharge under the new tax regime has been brought down from 37% to 25%. This will bring down the overall the peak taxation rate from 42.7% to about 39%. So overall, the new tax regime is being made a lot more attractive. So because of this, I believe that significant amount of population will move towards a new tax regime. And apart from that, there were a little bit of apprehensions regarding whether the long-term capital gains tax, especially for the equities, will be tinkered a bit. 1 year and above is considered to be long-term tax rate, and which is at 10%. There was some expectation that while fixed income, the long-term is considered to be 3 years and beyond, and equities, the long-term is considered to be 1 year and beyond. There was a fear that both of them will be brought under the same tenure. So that really didn't happen in this budget. So that's, I would say, on the positive side, vis-a-vis probably what market was fearing. So that these are the two things in the personal income tax side.
That is clearly a move in the right direction to have it simplified for people who find the whole activity of filing taxes so stressful in the first place. Are there any other key announcements in the budget that you'd like to highlight, Mr. Reddy?
One of the key announcements in budget was regarding the tax proposals and the insurance policies. I think that about 2 years ago, unit-linked policies were brought under the tax net, which are with an aggregate premium of more than 2.5 lakh rupees per annum. Unit-linked insurance plans will attract the the taxation. So that was introduced 2 years back, and in this budget, government has introduced the taxation of the traditional policies also. So for all the traditional policies, which are non-unit linked policies, if the gross premium on an aggregate is more than 5 lakh rupees per year, anything beyond that is taxable. That's what has been introduced. I would think that is slightly negative for the insurance industry, even though large part of the insurance customers are really smaller ticket savings customers. There are certain larger ticket savings oriented policyholders are there with the insurance industry. I think for that segment, disallowance of income tax beyond 5 years of aggregate premium is a bit of a negative for the life insurance industry. But outside of that, I think most of the other sectors, I would think, are generally going to get positively impacted, largely because of budget towards the consumption and investment activity.
As we wrap up the conversation, I also want to touch upon what's been playing on a lot of people's minds recently. What would you say is your market outlook for investors, Mr. Reddy?
We have been somewhat cautious on the market last couple of quarters, especially the high inflation level across the world. Interest rates were moving up, even though now we have come to peak of the interest rate hiking cycle, but the interest rates are likely to continue to be at these elevated levels for some more time. So in that backdrop, we were somewhat cautious in the market. When the interest rates are at these levels, naturally it will have an impact on the equity valuations, especially it will have an impact on the cost of capital, and also high interest rate would have some impact on the corporate profits as well. So because of both these reasons, we were expecting that the market to be subdued. We think that given the interest rate will continue to be there at these elevated levels, probably market would stay muted for a couple of more months, maybe. That's what our initial expectation was. But given that the budget was really a lot more growth oriented, and we are coming to the end of the interest rate hiking cycle, we're turning positive on the market now. There has also been some amount of correction taking place in the market in the last few months. And in fact, if you see the last 1 year returns are pretty much almost like, I would say, nil. While the corporate earnings have grown quite well in this period, that has led to the compression in the valuations. Maybe a couple of more months we could see the subdued performance in the market, but we are really getting into the attractive zone from a long-term investment perspective.
And finally, Mr. Reddy, before we let you go, are there any key points that you'd like our listeners to take away from the budget? If you could summarize it in quick 1, 2, 3 terms, I think our listeners would be super happy.
Outside of the insurance sector, I mean, where the taxation and the traditional policies being introduced in this year, outside of that, I think pretty much everything is in the positive side in terms of sectoral impact wise. That's point one. And more importantly, the market really liked the overall fiscal deficit and the fiscal deficit target and the gross and net borrowing numbers. So the net borrowing numbers, at 11.8 trillion rupees was really, in line with the market expectation or slightly below that. Because of that, bond yields have already rallied in the yesterday and as well as today. So that's a positive thing. The interest rates have almost come down by 10 basis points in the last 2 days, yesterday and today taken together. So that is, generally, as I was mentioning, interest rates coming down is relatively positive for the equities, and also, of course, with interest rates coming down, bond funds also will do well. So that has been the positive aspect in the budget. In terms of focus areas, especially for some of the sectors, especially for the EV sector or automobile within that EV sector, there's been a good intent and emphasis transitioning towards electric vehicles. And in fact, the finance minister has mentioned that all the government vehicles which are more than 15-year-old, they will be scrapped, and she's allocated some good amount of money towards scrappage of those vehicles. That will create a good demand for automobile sector. That's if the old vehicles are scrapped, that automatically creates a demand for some of the the new vehicles. So that's on the positive side.
So there you go. You heard it all from the perspective of the Chief Investment Officer of Bajaj Allianz. Hopefully all the salient points of the budget are clearer to you. And here's hoping that this coming financial year is as good to you personally as many experts are claiming it is good for the country. And finally, our thanks once again to Mr. Sampath Reddy. And for more such conversations, please join us yet again on Life Goal Podcast, brought to you by Bajaj Allianz Life.
The views expressed by the speaker in the podcast is not to be construed as investment advice, and listeners are suggested to seek independent financial advice before making any investment decisions. For more details on risk factors, terms and conditions, please read the sales brochure available on www.bajajallianz.com carefully before concluding a sale.